Hello investors, welcome to the latest edition of the Bank One Investor Circle. So today we have the pleasure to welcome Frédéric Taisne from bridport, of course, Swiss-based brokerage firm with more than 30 years of trading experience. So today, Frédéric is with us at the Bank One Waterfront office and will be sharing his updates on the financial markets. So hi Fred.
Hi Kush. So happy to be here because it's been a long time we couldn't travel because of the pandemic. So happy to be back.
So thank you Fred. So if you could give us your analysis on the latest macroeconomic environment.
Yeah, with pleasure. So today, central banks have an impossible mission to accomplish. Stopping inflation without breaking the growth. So that's why in the economy you have two camps. So you have those who believe that the growth will still keep going on with a strong labor market and healthy corporate balance sheets. And those who believe that the recession is coming and the soft landing is inevitable. But for inflation, this is the same. Which kind of inflation will be the new norm? Will it be the US-like inflation driven by wages and corporate margins, or more inflation like we have in Europe, which is led by commodity prices and energy? So we don't know. So this being said, I think it's a bit too premature to add risk with so many uncertainties. However, I think this is the right timing to start looking some good spreads, good rates, with according to given the level of the market rates, the spreads, and the good carry, without taking too much duration risk. That's why we would stick to defensive and liquid sectors and still avoid sectors with too low yield and too cyclical.
So thank you Fred. So which segments of the market would you recommend to investors?
Kush, in a nutshell, I would say we have 5 segments which in bridport we like. The first one, the Euro universe. We tend to like very much the corporate hybrids with short-dated call, so preferably below 2025. Why? Because historically it's been a very investor-friendly asset class, where the coupon deferral is quite low and the extension risk is quite remote, especially for issuers rated by Standard & Poor's, because you've got the protection in that case, which makes of this asset class one of the best risk-reward in the Euro segment. The second sub-segment in Euro is short-dated high yield, because it's quite easy to find over 3% yield there. Also in Europe, according to Moody's, the default rate is quite low. I think it was quite 1.2% last year. But we prefer short-dated to stay short to avoid taking too much risk in case of rates coming up. Another place we like in Euro are financial subordinated debt, so AT1s, Tier 2s. Why? Because European banks are very well capitalized, so they tend to have a quite low default rate. Also there, it's a very good risk reward as an asset class. And above all, I prefer to avoid the low yielding, good quality names in Euro corporate because you have too high sensitivity to rising rates, on the bigger risk of loss in that case, and too little compensation in that field. The second bucket in dollars. There with the curve this high and flat, you don't need to go very far on the curve and very deep in terms of credit risk to get good value. That's why we like to stick to low investment grade, typically BBB minus, with good fundamentals. 3, floating rate note structures are kind of natural in the rising rates environment. And especially building a portfolio with a negative sensitivity to change in rates, it's a good idea in my view. One we like quite particularly is the General Electric Perpetual, one which was issued originally with a 5% coupon, which is now in the floating rate mode. The fourth segment are the commodity players, especially in Brazil or why? Because it's quite remote to geopolitical risk you have in Europe at the time being. And to finish, I would say, yeah, with the greening of the economy, we like the sustainability-linked bonds. It's a growing asset class in the ESG segment. So with a lot of inflows, so there you can expect a good performance of your investments. It attracts a lot of new inflows. On the metrics, on the norms, we believe will come soon. So as a recap, avoiding cyclical in times of stress, increasing this component when it comes less tense, keeping an eye on emerging markets with very selectively, taking an eye on inflation-linked bonds as well. So taking opportunities in this market in a very diversified portfolio format. This is what we would tend to do.
So thank you very much for your comments, Fred. With the coming elections in Kenya, so what is your view on the general bonds market, including the Euro bonds?
Yeah, my pleasure. Yeah, we are quite involved with some clients also. Let me try to give a few observations we made on Kenya. First of all, East Africa, we observe a clear recovery, 2021. But first of all, let's take a step back and give a few background political and macroeconomical comments before. On the political scene, as you know, general elections are coming, presidential and parliamentary in August, with two very close candidates, same ideology, 42% intention of votes each. There, we only see a little risk of potential fiscal slippage after the elections, so we have to keep that in mind. On the macroeconomic front, let's start with the negatives which we see. First of all, yes, the growth is lower, so it's a slowing economy, 5.7% according to IMF versus 7.5% last year. You've got a fiscal deficit quite high, 8%. Current account deficit around 7%, quite high. Elections coming also could bring negative news, which is not something we like. And also, we have to remember that Kenya is a commodity importer, and for that reason will suffer more than commodity exporters. So those are the negatives, but we see much more positives actually in personal judgment. Last year the IMF granted an extension credit facility to Kenya to finance its reforms. We're expecting under the third phase $244 million to complete this program. We see an improved operating environment thanks to a better financial health of corporate, and with a better and higher than expected agricultural exports and production. So this is very good. For the bond side, I see a low probability of new issuance of debt just because we are in June, and at the end of this month, this is the end of fiscal year. So the government will probably use bridge loans to fill the 8% fiscal gap rather than new issues. Also, Kenya is less sensitive to commodity shocks than the other sub-Saharan countries. So this is why the spread of Kenya has widened much less than its peers. So overall, what sort of conclusion could we draw from these remarks? First of all, technically it's an oversold market. It's a very usual short, given the very uncertain macroeconomics. So I tend to prefer the low cash price bonds on the Kenya Govies curve, which have corrected a lot. So to avoid the gap risk on the liquidity, I would avoid the very short dated of the curve, who have usually a higher cash price. So if I would pick just two of the bonds which trade together actually with other clients in Mauritius, I could give the example of the Kenya 7% 2027, which is a sinker where a third is redeemed in 2025 and 1/3 in 2026 before redemption, which by the way gave you a duration of shorter than the usual bond, bullet bond. So in context of rising rates, it's a better adjustment, better protection. We also trade a lot the 6.3 2034. There could be a good examples of bonds we like, but just to conclude, election is coming, so I think it's better to wait what's going to be the result. But if the results of these elections are much less disruptive and go much better than expected, then we could potentially see a spread compression of Kenyan credit versus Ivory Coast, Senegal and South Africa. And also on the curve, we could observe a steepening of the curve between the 5 and the 10s.
So thank you, Fred, for your valuable comments.
Thank you so much, Kush, for your kind invitation.
So dear investors, thank you for your time. Like you know, all these African Eurobonds can be traded on the Bank One Custody platform. See you soon for the next edition.